So, Taras, I get a lot of the questions. We're going to do a series of these. So, especially from the first time home buyers. And one of the questions that comes in first for the most time is, I don't even know, am I ready to buy?
Yeah.
So, of course, from the real estate, point of view, I have my answer. How would you answer that? If somebody comes in and says, hey, I get it, this whole hype about homeownership,
Yeah.
how do I know if I'm ready?
Yeah, that's a really good question. So what I tell clients that come in and say, Taras, should I even start looking at real estate? Am I ready to buy? What I'll go out and I'll say, the step one, of course, is going to be to figuring out a budget. So I'll tell them, this is what we need in order to get you exactly to a T from a budgeting standpoint. Do you know what your budgets are? And the most important thing for clients to, I want to say, not just realize, but to understand is what's in a mortgage, what's the most important thing is going to be the payment. Right.
Gotcha.
So we budget around their desired payment, and then we go from there. So I'll say, hey, let's get everything in. Let's get an application through. Let me sit down and figure out your budgeting plan. Do you have money saved? Do you not? So that way we know exactly what we can get them qualified for. And then once their budget is dialed into a T, then we know exactly what they're approved for. Right. My philosophy is nobody in life is not qualified. They might not be qualified right now, but everyone could put a game plan together to become a homeowner.
No, I love that approach for sure. Then it goes into, what does my credit score have to be?
That's a really good question. So it really depends on the mortgage program. There's a lot of programs out there. The main number, the rule of thumb is you want a 580 or above FICO score.
Okay.
Now, if you have a lower credit score, I encourage everyone to still try to get a loan because we have a system on the back end that will tell us exactly what they need to do in order to bump up their score. It happens all the time. People want to qualify to a slightly better program. We'll say, okay, let me run this, and I'll tell them, tweak this on your credit card, pay this down just a tad bit, and go open up this new account. Their score increases by 20, 30, 40, 50 points, and they qualify.
Okay. So on that topic, if, say, we take husband and wife, two people, he is working. Those are like literally like real questions. That's why I really wanted to make sure that if I share this somewhere, people can find it useful.
Yeah.
So husband and wife, husband is working, his credit score is not so good.
Okay.
The wife, on the other hand, often has a really good credit score because she's using all of those department stores credit cards.
Yes.
So she has a really good credit score.
Yeah.
But she's not working.
Yep.
So how do you go about that? Does it even make sense to add her into the loan?
Okay. So another phenomenal question. So to add her to the loan, it depends on the program. So for example, if we have to go with what's called an FHA loan, right? FHA requires us to look at debts of spouses. So regardless, we're going to have to pull her credit to confirm her debts. If we're going conventional and their debt to income ratio is less, then oftentimes I will add the spouse to the loan because we're actually able to do what's called a blended score with the husband and the wife. What we could also do, and I recommend this only partially, that's after me reviewing the file, is say, hey, why don't we do this? Let's add your spouse, whether it's the wife or the husband, whoever's lacking on the FICO score, to your spouse's credit card as an authorized user. Wait 15 to 30 days. And oftentimes the score goes up, but that's very situational. So don't do that unless somebody like a professional is able to review your FICO score.
Awesome.
So that's kind of what I look at. And of course, the number one thing is if we need to increase the husband or wife's FICO score, how does that look like? And if it's possible to do it within 15 days or 30 days, and oftentimes it's very possible.
Okay. Well, you kind of touched on my next question that I had is, if somebody comes in, and I know previously working with you, I know you have done this, but just so people understand, somebody comes in and maybe they're not there yet, or maybe it could be better. How long does it usually take? And it probably depends on how much of an improvement that we have to have. But somebody that needs to bring up their credit score, I mean, again, it probably depends on how much, but how long will it take an average person to be to up their credit score? And there's also so much out there, on the internet, you go and there's all these companies and so on. Do you have any preferences or like some people that you can refer and say, hey, this is legit? Of course, you probably don't want to, do that. But is this real, I think? And is this possible? And also, does it take a long time for somebody to improve their credit?
Really good question. So to improve, there's really, I want to say 3 factors.
Okay.
Factor number 1 is once we everything pulled through, I'll take a look and we'll say, okay, can we improve their credit immediately? And oftentimes it is possible by 20 plus points.
Wow.
Now, if it's not possible, then it's going to be a 3 to 6 month period. 2-3 months, sometimes 6. It really depends. The algorithm will actually tell us if they do this for 2 months, it gets improved. Now, let's say I personally run everything through and I'm like, okay, this is a little bit more, let's say, complicated, right? They have multiple delinquencies. They have a bankruptcy maybe that happened recently. They have missed payments on several of their accounts. Maybe they have an issue with a creditor or two. What I'll do then is I'll say, here's a referral to a company that specializes in credit repair. They're inexpensive. It's a couple $100. It's literally not expensive. And they will go there. The company's called Blue Water Credit.
Okay.
I have their contacts. So then they would reach out to Blue Water, and Blue Water will pretty much do everything for them on their behalf. They just have to send over the right docs. So they'll get their credit repaired. Then Blue Water will reach out to me and say, hey, Taras, their credit score's fixed. Fantastic. I repull. I call you and I'm like, Irina, we now have a home buyer.
No, I love this. No, there's a reason why I wanted to ask this question. Well, first of all, I get asked those questions, but also just so people understand that sometimes it's a process, and I love it. Working with you for that, for that reason. One of the reasons is that even if it's not right now, we don't just like turn you away and like, hey, sorry, come back later. Yeah. There's a process that you're able to walk people through and, refer them out and get people to that point. So if somebody feels that they're not ready, oh my gosh, I know my credit score is not as good or whatever, instead of sitting there and feeling down and thinking, oh my gosh, I'm never going to do this, honestly, reach out.
Yeah.
There's ways, and it's going to happen way much quicker if you're working with somebody who knows what they're doing and can tell you what steps to take and be effective for sure.
And you hit it right on the head, right? From a timeline standpoint, I like to say a goal or something you want to achieve is just a dream until you put a timeline behind it, right? Yeah. So what we do is we build a game plan. We're going to build a game plan for you specifically. Hey, this is what you need to do. This is how long it's going to take. And oftentimes it's not very complicated.
Right.
Sometimes we'll say,
when you know what to do.
And we know exactly, we know what to do. So we'll build a game plan. Everyone's qualified, maybe not right now, but everyone is qualified to buy a home. It's just a matter of time and how they get there. To learn the how is huge. Sitting on the sidelines, oftentimes if somebody goes, hey, I'm just going to try to do this myself and wait, oftentimes that damages their credit, or that damages their situation overall scenario. And I'll talk to them and I'll be like, gosh, I kind of wish you came to me 3 months ago.
Right.
Because 3 months ago, this would have been an easy fix, right?
Yeah.
But now it's a little bit more complicated. That's okay. We'll work through it.
It's still doable.
But if you think you have an issue, or you think this needs to be resolved, or if you want to buy in the future, right? Put a game plan together. Connect with Irina, connect with myself. Let's put together a plan for you so that we can get you into your home and oftentimes protect what you have going on right now so that it doesn't get worse.
Awesome. No, I love this. So you kind of touched on this, but debt to income ratio, also known as DTI.
Yes.
Sometimes I'll have buyers that will say, what do you mean? Like, I don't understand how they only qualified me for $300,000.
Yeah.
I make, this
X,
much.
yeah,
Yes.
yeah.
And so touch on that a little bit, like maybe how it works. What does it mean?
Yeah.
I mean, I don't know if there's a formula, but so here's why. You make all this money, but you still don't qualify for as much as you thought that you would because of.
Yes, very good question. So DTI is calculated differently with somebody that's W-2'd, works for a company, and somebody that's self-employed. So let's start with W-2. Let's say you work for a big company. We look at how much you make per month in income. Now, debt to income simply means your total debts, which are minimum payments on credit cards, minimum payments on car loans, minimum payments on student loans, boat loans, any kind of debt that you have, we take your minimum payment, excluding medical.
Oh, okay.
We do not include medical. So personal debts plus your future mortgage payment. Okay. Then we take that number And we want that number to be 50% or less of how much money you make. So for example, let's say somebody has 2 or 3 credit cards, plus let's say hypothetically they have 1 or 2 car loans, plus the future mortgage. Let's say total is going to be $4,000. $4,000 future mortgage and all their current debts, which means their gross, not this before taxes, not after, gross monthly income to qualify for a conventional loan needs to be at $8,000 a month. That's a 50% debt to income ratio, right? Okay. Then of course it depends on the loan program. There are some investors like first-time homebuyer loan programs. They'll say, hey, if you're a first-time homebuyer and you don't make more than X, you'll get a slightly better interest rate, like an eighth better, but they want your debt to income ratios to be under 45%. Okay. So we calculate that a little bit differently. If your credit score is lacking a little bit and we have to do an FHA loan, they'll allow your debt to income ratio to actually be up to 55%. So every loan program
is it because they feel like this person is now higher risk?
Correct. And with that higher risk, they do tack on mortgage insurance.
Gotcha. Okay.
For the life of the loan.
Now this is really good because that's something that sometimes people just feel like, oh my gosh, they concentrate so much on what they make. Yeah. Not realizing, and it's unfortunately a very easy thing to do. Before you know it, you have all these payments. Even it feels like, oh my gosh, I make all this much.
So I say get the home first before the car loan. Because that's a big. Car loans are the #1 hindering factors of people not being able to qualify.
Those are larger payments.
Well, yeah, those are much larger payments. $50 in debt affects your buying power by around $10,000.
Wow.
So think about it that way. Yeah. So if you have a car loan of $500 a month, what's that? You could now buy literally $50,000 plus less in home. Now, if you're self-employed, debt to income ratio is different. Self-employed is we look at your net, what you've claimed on your taxes, and we do a 2-year average if you've been in business for less than 5 years. Right. If you've been in business for more than 5 years, it's a 1-year average.
Okay, gotcha. Yeah, self-employment, it's a whole different topic itself. Yeah, for sure. No, very nice. So next one is, and especially, again, first-time home buyers that love the idea of the home ownership and all of it, how much minimum down payment do I have to have? And can I even buy without a down payment? Which I know you can. We'll touch on that. But on, say, FHA, or conventional, whatever, the minimum the person has to come up with the down payment. So
minimum down payment on conventional is 3% down. Minimum down payment on FHA could be your first home, second home, your third home. It could be, if you're buying your first home and you're buying a multifamily, 3.5%. Okay. So 3.5% on FHA, 3% first-time home buyer program, conventional.
Awesome. Since we are on the types of loans, there is also this, stigma or understanding for many people thinking that if I am a first-time home buyer, then it's always an FHA. In fact, some people think that if they're doing the FHA, it's a good thing. Yeah. So tell me yes or no, and
the differences maybe?
Maybe the differences. And also, I think that people are like, I'm a first-time home buyer, so I get the FHA thinking like it's such a good thing. Yeah. Is it?
Yeah. So FHA, it stands for the Federal Housing Administration. Right. It's a government loan program versus conventional. Conventional is not a government loan program. If your credit score is lacking and you have a slightly higher debt, it's a great program to help clients qualify into homes. A lot of first-time home buyers use it because their credit scores lack or because they have a little bit more debt. That's why I have that stigma. Right. My goal with every client that gets on an FHA loan is to refinance them out of FHA onto conventional. Okay. You want to be on a conventional loan. The main reason being is FHA, government loan program, because you're looked at a slightly higher risk. They give you what's called private mortgage insurance. Right. And that private mortgage insurance could be $200, $300, $400 a month, will sit on your loan for the life of the loan. Right. On conventional financing, the second you pay off 20% of your home, that mortgage insurance, it's no longer private, it's just base mortgage insurance, comes off. Awesome. So the goal is to get out of FHA onto conventional. Yeah.
So with all of that said, first-time home buyer can be on conventional, correct?
Yes. Okay. Oh, yes.
There you go.
3%. It's actually less down payment.
That's what I wanted to hear.
And it's a better program.
Yeah, absolutely. Better program. Yeah, I know that. So going back to the down payment, can I buy without putting any money down?
Yes, it's possible. So if you are, let's say, in the military or you've served in the armed forces, we have VA loan programs that's zero money down. If you're looking in a rural area, outskirts of the city, there's a map. That program is called a USDA home loan. You can put with zero down. There are also down payment. They call them down payment assistance. I don't like that term. That's what it's called.
Right.
Most people think it's a grant, but really it's not. But they're called bond loans, really. So a down payment assistance loan or a bond loan simply means that we'll take your down payment that you need and part of your closing costs, and we will roll that like a piggyback on top of your current loan. The thing about bond loans, our payments are going to be a little bit higher. The rates are going to be a little bit higher. So it's an overall not the, I want to say, greatest loan program, but it will definitely get a family in the home with zero money down.
Gotcha.
Yeah.
And that loan, as I understand, you don't make payments on it, correct?
The bond loan, the second loan?
Correct.
No, you do not make, but your interest rate's going to be a little higher.
Right.
On the primary, you will make payments on that loan once you pay off the first. Okay. Oftentimes with these programs, people will do a refinance a couple of years later onto a conventional loan, and then their loan amount they'll see kind of increased, and that's because of that second piggyback small loan.
Awesome. No, I love it. And I think one of the last questions I think I would have is, again, we talked about refinance.
Yep.
What is the soonest after purchasing a home that somebody can do a refi?
Legally, tomorrow.
Oh, okay.
So you can refinance the next day. Lenders don't like that. On a macro standpoint, oftentimes it's because the company says they want you to hold onto the mortgage for at least 6 months. Okay. Legally speaking, it's your home. You can refinance it the next day with a different investor. If I have clients that I'm clients that I'm funding today and last month and the month prior, if the market shifts and rates go down dramatically, I will be refinancing every one of them because that's in their best interest. Majority of companies or lenders are going to say you have to wait 6 months. Well, the reason why they want you to wait 6 months is because if you refinance within a 6 month period, they kind of lose their pay or their commission check on their loan.
Interesting.
Yeah. So
I didn't know that.
Yeah, so
okay.
I say,
okay.
personally, because for me it's 100% irrelevant, we want what's best for the client. Right. If rates go down drastically, we're refinancing you. That's it, because we want you to be in the best loan possible.
Okay.
You can refinance the day after.
Okay, awesome.
With any bank.
What is the cost for the refinance?
That's a great question. So the cost of the refinance usually 90% of the time is similar to your closing cost that you have on your house.
That's not bad.
So it's very similar. Could be 6, 7, 8,000, right? Appraisal is a big factor. If you're refinancing really in a close proximity, I want to say within when you purchase 1-2 years, oftentimes we can get a property inspection waiver. With my company, it's a lot different. If I did your mortgage, we are the second largest servicer in the nation. We service a little over $63 billion in loans. So we hold onto your loan. What does that mean? If I did your initial mortgage and you decide to refinance, we call it a streamlined refi. Processing and underwriting fees pretty much cut in half or more. We don't have to roll your prepaids because we're servicing the loan.
Right.
Less work for title and escrow, so those costs are a lot cheaper. The cost is over 70% less doing a refinance with us if I did your loan originally, because we are holding on and we're servicing the loan. The only thing that we're shifting around is really going to be the term of the loan. So on a macro standpoint, usually it's expensive. With us, if I did your mortgage, because we service our loans, it's going to be a lot more cost efficient, and they don't have to pay for it if they don't want to. We can roll that in the back.
That was my
loan.
next question. Yeah. No, I love it, and that's when it comes to really show that it's important who you buy with. I mean, and on the lending side, of course, on the buying as well. But well, thank you so much. This has been really awesome, short and sweet. But those are really the most asked questions when I first meet with somebody. And even though I do know some of those questions, on a general level, it's always nice to get from the main source. So thank you so much.
Of course. Thank you.